The Russell 2000 shows strength like this way more often than the S&P 500 does. So in today's video, I'm going to show you guys different instances in the past of when the Russell showed strength like this and eventually ended up falling over. So we're going to take a look at that. Then we're going to take a look at the S&P 500, the NASDAQ 100, the VIX, the bonds, and the dollar. All right, this is going to be a fun video. Without further ado, let's get started. All right, so very simply, this is a chart of the Russell 2000. And the Russell 2000, let's just give context for the day, is up. It was up $1, 1.5% today. The NASDAQ was down 1.7% today. And the SPY was down a tad bit at 0.35% today. So the Russell was the main winner, right? So what we're seeing right now is that the Russell, this indicator right here, the blue lines are the Bollinger Band. We're seeing the Russell very overextended to the upside in terms of the Bollinger Band. And when it moves like this, when we get closes and opens outside of the upper level of the Bollinger Band, that denotes extreme overextension to the upside. And moves like this do not sustain themselves. So if the IWM was closing outside of the lower level of the Bollinger Band for multiple days, eventually what would end up happening is we should reverse back inside dramatically. So the same concept is when we are trading outside of the upper level. If we continue going up higher, there will be a point where we return back inside dramatically. Okay? So the thing with the IWM is that it has way more room to wiggle to the upside compared to the S&P 500 or the NASDAQ. So there has been many more instances in time where the IWM can continue going up and staircase up a bit, but then eventually they always return back inside. So what I want to look at is the different instances in history where the IWM opened outside of the upper level, closed outside, and it continued going up higher. All right, so let's first take a look at a few of those times. So the first instance in the most recent times that the Russell continued to move upwards outside of the upper level of the Bollinger Band was in November of 2021. So this is the chart of the Russell 2000. This did not happen on the S&P 500 or the NASDAQ. So you can see that there were multiple days. We had one big close outside, and then we had 3 days in a row where we continued to open and close outside of the upper level of the Bollinger Band. What ended up happening was, if you were getting into longer term puts, what ended up happening was we eventually gave back all of the gains from the first initial close outside, right? By November 10th, we had closed lower than the November 4th day where we initially opened and closed out, right? So that was within 6 days, calendar days. And then, we ended up falling much more dramatically over the next few weeks. But this overextension, what I'm showing is that it could continue on the Russell 2000 specifically. It could continue more often than not compared to the S&P 500 and the NASDAQ. And it could continue for days, right? But then eventually my thesis, and looking back in history, every time it reverses back inside and the gains end up evening out. So this was the first time in history in November of 2021. Sorry, it was the first instance in history most recently, and that was in November of 2021. The other time that this happened was in February of 2021. So a few months prior to November. And again, we had one close, open and close, a second open and close, and a third open and close. And then a fourth day where we had a red day. And then the coming weeks afterward, we ended up falling much lower. And then we had a much bigger drawdown basically that month. So once again, it's showing that there is more room to the upside, but this room to the upside is not a reason to go long because the risk reward for a continued move up is very, very slim as the move continues to go up. So pragmatically, right? Clearly, there's a lot of strength in the IWM. Clearly, right? But what this is showing in history is that if you were to go long on the close of February 8th, right? You're following the momentum to the upside or you're waiting for dips to buy, right? when the market is this overextended to the upside in terms of the Bollinger Band, it is it does not make any sense historically, statistically, to be leaning long. It makes way more sense to be leaning short, or to essentially just wait for dip buying opportunities. But even then, after multiple days of closing and opening outside of the upper level of the Bollinger Band, basically every time that this has happened, we've seen a big pullback eventually. So before I continue with the rest of the video, one other thing that I want to explain to you guys is when the Russell is trading outside of the lower level of the Bollinger Band as well. So I want to drive this point home. So basically in January of 2022, right, we can see multiple days where we're trading, where we're closing outside of the lower level of the Bollinger Band, right? But this is multiple days where we're just continuing to fall. Hamid, I thought we were very overextended to the downside. What's going on? So what I'm showing here is multiple days in a row, there was clear bearish momentum, but intraday, we would always revert back inside the Bollinger Band. So because we were reverted back inside the Bollinger Band, we would bounce, right? Or we would get some sort of a move to the upside, and then we would fall lower intraday. So these were opportunities for people to load short, and it was a staircase down. That's so essentially the days where we blatantly opened and closed outside of the lower levels or the upper levels, that's when things get difficult. But on certain days here, we were opening inside the Bollinger Bands, and then we ended up closing outside. So if you're still opening within the Bollinger Bands and then closing outside, the real true overextension in terms of Bollinger Bands occurs when you are opening and closing outside of the Bollinger Band, either the upper or the lower. If you see an open within it and then a close outside, then that gives more room to a continued move in that direction, because it's not an overextension. It's only an overextension if it's opening and closing outside. So far, when we go to today's chart, this is an overextension. We're opening and closing outside. And historically, we could continue rising up. That is fine. But what we've seen is that over a month, they always ends up reversing back inside. And by the time everyone is very, very bullish, it's now especially so we missed this move to the upside. That's fine. But pragmatically, now is not the time to start going long. It is not safe to go long. The risk reward in terms of an upside move, like I just showed you with February and November of 2021, it does not make sense to go long, in my opinion. So there's that on the IWM. The next levels of resistance on the IWM are 188 and then 190. This is a really strong indication that there should be a pullback soon. If we get another open and close, tomorrow, and then for 3 days in a row, what we've seen so far historically every single time has been there has been a reversal back inside. So I hope that made sense for the IWM. Now let's go ahead and take a look at the dollar, the VIX, and the bonds. All right, so this is a chart of the dollar. We know that the dollar has an inverse relationship to the market. If the dollar is rising, then that is bad for the stock market. But what we're seeing right now is that the dollar is continuing to have trouble at this level of resistance. And the more trouble that it's having at resistance, right, the more bullish it is for the stock market. If the dollar cannot break above these resistance levels at 104.50 or these highs here, then that is very good for the stock market. And clearly, currently, we're seeing the dollar having trouble here. And if it continues having trouble, good for the stock market. All right, next, let's take a look at the VIX. All right, so the VIX has an inverse relationship to the market as well. If the VIX is falling lower, that means that the stock market should be rising. Okay, the VIX is lower than any level of all of 2021. We are back to 2020 levels on the VIX. So we've fallen lower on the VIX than the entire quantitative easing phase of the Fed. And that's really, really crazy. So essentially, when you're looking at the Bollinger Bands on the VIX, it's still showing that there's more room to go to the downside, right? So we closed outside of the bands on Friday. We closed outside of the bands yesterday. And today, you can see that we closed within it. So there is more room to continue falling lower because the bands are going to continue falling lower, and the candle itself is also going to continue falling lower. So it's not going to be overextended to the downside. And as this continues falling lower, as there's more and more weakness to show, that means that the stock market is going to continue showing strength. So it is very important to realize that we are at pre-COVID levels on the VIX. That is not going to sustain itself. And just keep that in mind as well. We are, it's crazy, to be honest. Very, very interested to see where this is going to take us. But basically, it's not the time to be shorting the VIX. It's not the time to be shorting volatility. It's time to be going long volatility, because back in January of 2020, February of 2020, that was the top of the market. So that's where we're currently sitting on in terms of the VIX. The VIX back in basically back here in January and February of 2020 was at these same levels here. And this is really, really insane that we're trading down here, close to 1350 and 14 levels. So this is where the market was bouncing, and yeah, so just keep that in mind. Next, let's go ahead and take a look at the S&P 500 and the NASDAQ. So what I thought was going to end up happening was the exact opposite. I was saying go long tech and go short the Russell. What ended up happening was the NASDAQ fell dramatically, and the IWM, or the Russell, shot up. So the exact opposite happened. All right. So what was, again, the easiest trade, and what continues to show as a level of resistance, is just going short at this level of resistance on the S&P 500. It's clearly showing resistance here at this 429 level, and we're just bouncing around at this level of resistance, and a lot of it is due to the drop in the bonds. We didn't go over that, but the bonds are falling. So the bonds are falling, right? So the bonds have a correlated relationship with the market. If the bonds are showing weakness, then generally the stock market is also showing weakness, but it happens at a delay. So the bonds are showing a lot of weakness. The NASDAQ was also showing a lot of weakness, and the Russell is showing a lot of strength. So the Russell had a 1.5% green day, and the SPY could not have a green day. So it goes to show how much the Russell has an impact on the S&P 500. And I just want to make this very simple. Basically, if we break below 424, 425 on the S&P 500, then the upward momentum on this, it's going to be very difficult to maintain. So that's why they're trying very, very hard to hold this 426 level on the S&P 500. Okay, so 426 and 424, major levels of support on the SPY. What ended up happening with the NASDAQ is we broke below these levels of support. We were having trouble here at levels of resistance, and we just broke down below all of them. So now the next major level of support is going to be this low here at 346.50. And 346.50 is the equivalent of basically 426 on the SPY. So a break below 344 and then 342 on the NASDAQ is going to be the equivalent of 424 and 422 on the SPY. So currently we're in a interesting spot here in the market. The Russell is continuing to show a lot of strength. It can continue going up, but overall, it's going to be a very juicy short if we catch it. And of course, having proper stop losses and managing your risk properly and everything is the way to go. Regardless, I am not infallible. This could be the time in history where it doesn't pull back, right? But what we've seen multiple times is that this is when the Russell tends to pull back. These moves cannot sustain themselves. You just need to have money, and you need to buy enough time on your option contracts so that your the theta does not burn the premiums. You need to just have enough wiggle room. And yeah, clearly this is not a bullish setup on the NASDAQ, but we're coming to levels of support. We could bounce on the NASDAQ. You know, those are the levels of support and resistance on the NASDAQ. Those are the levels of support and resistance on the SPY. And I explained my thoughts on the IWM. So, yeah, no, there's that. And I'm still going to be bearish, especially as we are climbing like this on the IWM. I am not going to be bullish. We are very overextended to the upside. And if you have money and you can buy out, if you could buy these longer term puts 2, 3, 4 months out to be safe. I mean, like, statistically speaking, like, we've never had a point where we didn't revert back inside. So I'm just giving you guys my thoughts and sharing my thoughts with everything and how everything is playing out. So I hope you guys enjoy the content that I'm providing, and I hope you guys have a wonderful day. Please make sure to like, comment, subscribe, do all that good stuff, and I will see you guys bright and early tomorrow morning. Thank you.